Hello, this is Griffin Bridgers. Before we jump into this video, this is a recording of a webinar I conducted on May 15th on the separate account rules, new and proposed for IRAs and qualified plans and other defined contribution plans. So a couple notes before you jump in. One, in a few places I mentioned a December 1 date. That was an error. That should be December 31, in particular, December 31 of the year of a participant's death. Also note that a couple limits on this video. One, it's not intended to substitute for legal or tax advice. I've created this for an audience of other wealth transfer professionals and not for use by the general public, so feel free to log off if that does not describe you. Also note that this was really just a high-level webinar meant to skim over some different topics. So as a follow-up, this suggests some action items like custom drafting of revocable trusts, and there's no language or guidance provided on that front. So understanding those bounds, feel free to listen along to this webinar recording. Okay, so let's go ahead and get started. I know we have a few others who are probably going to join midstream, but this will be recorded and circulated after the fact. But first off, wanted to thank everybody for joining us today. I apologize if my voice is a little scratchy. I've been a little under the weather, but hopefully doesn't gum up the works too bad on the audio for today's presentation. So as you see, this is called New Possibility with Separate Account Rules, and we'll get into what that means in terms of IRAs and qualified plans and some of the implications both under new rules that were well overdue, but finally were finalized last July. Then also some proposed rules that may also help here that are still proposed. They haven't yet been finalized and could still change, but we'll give you the state of where they stand today and then a little bit more of how we should be interpreting those. So here's the broad question, and I think this is something where when we're dealing with IRAs and qualified plans, there's all sorts of complex rules. And as much as I would love to say that we can make those as simple as possible today, that's unfortunately not the case with a complicated subject like this, because there's all sorts of weird rules where we mix entities that have a infinite life, like a trust, up to maybe the rule against perpetuities period, or LLCs or other things with individuals, because obviously the IRS doesn't want a tax deferred asset to remain tax deferred forever. So it used to be the case that with any individual beneficiary, you could stretch an IRA or a qualified plan over their remaining life expectancy. With a spouse, you could give them certain elections. But if you had a trust in play, that was a little more difficult. It still remains difficult, but there's one area where we've gotten a little bit more clarity, and that is around the separate account rules. And I'll explain the significance here in a few slides, but the significance relates to this general question of, can we simply name a revocable trust as an IRA beneficiary? Certainly that would be much easier for a lot of us, because if you've ever done beneficiary designation drafting, I think that is one of the most criminally underserved areas, because there's no standard out there. There's no guideline, and it's highly custodian specific, and there's so many pieces of information out there that vary on how complex versus how simple the beneficiary designation has to be. Now, in the past, when we had the old rules, what we were usually running up against, and this is where you got yourself potentially into trouble, is that in the worst case, if you were to simply name a revocable trust as a designated beneficiary, there's two worst case outcomes we would have. One would be a 5-year payout if the participant, i.e. the owner of the IRA, dies before their required beginning date. Then, if they outlive their required beginning date such that minimum distributions had started to happen during their life, then in the worst case, you'd be stuck with the ghost life expectancy, which favors situations where somebody dies early after their required beginning date, but doesn't favor situations where they die towards the end of their actuarial life expectancy. It could create a payout of even less than 5 years there. So that was the the issue we ran into with these types of things. And the ultimate goal under the old rules, and still to a certain extent under the new rules, is creating a see-through trust. This allows us to use beneficiaries' status as a designated beneficiary or eligible designated beneficiary when we look through the trust and the life expectancy of individual trust beneficiaries if we meet all the qualifications for a see-through trust. We'll see this requirement still holds true, but we also have the issue with the average revocable trust that it's going to have non-individuals who could potentially benefit either immediately from IRA distributions to the trust itself or from accruals of those distributions that could force us into that 5-year or ghost life expectancy payout, because our general rule is going to be that one bad apple is going to spoil the entire bunch. And why do we care about this so much? Why do we have on one hand these complex tax rules that don't align with the simple rule of just naming a revocable trust versus a situation where it might be favorable to just name a revocable trust? Well, I think the issue, especially when it comes to IRAs or qualified plans, is that you can't actually change the ownership of retirement assets. So with everything else, it's usually pretty simple to add it to a trust for individually owned assets like real estate, non-qualified plan assets that are taxable, and then other things like business interests and personal property. Those can actually be put into a trust during life. We can't do that with retirement assets. We have to name beneficiaries, and ultimately our goal with any estate planning is that non-probate assets can somehow be added to or directed to a revocable trust so that if we have to make changes to the estate plan, perhaps we can just simply amend the revocable trust itself and have that have blanket application to everything instead of having to go in and update assets like retirement assets on an asset by asset basis to change those beneficiary designations to align with the wholesale estate plan. So this is much more user friendly if indeed we can achieve this outcome of just naming the revocable trust. So while we're not going to get into a lot of the payout rules, we're not even going to touch the 10-year rule or anything like that. That's not the subject of today's discussion, because that's more a discussion on the heels of, can we get there first by having separate account treatment? But here's a quick illustration of what our 5-year rule says, where if we get shoved into that, in the worst case, there's no distributions required after the participant's death. But ultimately, what we're going to find is that by December 31 of year 5, the year containing the 5th anniversary of the participant's death, there's a lump sum distribution, which is fully taxable then to the revocable trust or to the beneficiaries who receive those distributed funds from the IRA. And if we get into the ghost life expectancy, we end up continuing to take minimum distributions based on the participant's schedule in the same way that the participant would have taken them if still living for their remaining life expectancy until the account is depleted. So with that, under our new rules, we still have some enhanced see-through trust rules, which allow us to look through the trust to determine among all the beneficiaries whether we have designated beneficiaries or eligible designated beneficiaries, all of whom have to be individuals, or if we have any bad apple beneficiaries like entities, things like creditors or estate or anything that could spoil the entire bunch. Because we have kind of, if you remember nothing else, this default rule that is changed in some circumstances, but really what we're trying to work around is this default that if not all beneficiaries are designated beneficiaries, then none are. And similarly, if not all beneficiaries are eligible designated beneficiaries, then none are. So we could have varying forms of bad apples with varying spoilages ruining things for everybody else. And even if we can achieve these, remember we have our rule that generally says the oldest countable beneficiary in a group is going to dictate the payout period for all beneficiaries. So when we move on from this, we find out that in a situation where we have multiple direct IRA beneficiaries or multiple see-through IRA beneficiaries under a trust, we have to look at this all or nothing outcome and find workarounds. And the good news is that we have separate account treatment now that is enhanced in order to do this. So, separate account treatment isn't a new thing for individuals. This was always available even under the old rules, but you had to have directly named individuals in order to achieve this. So, typically, if you had a beneficiary designation that said, like, okay, maybe to my descendants by representation or per stuperies, this is where you'd see this really kick in and apply. And we still have this carryover old rule now, but with some specific instructions we have to follow. One, we have a deadline. We have to get this separated out into separate accounts by December 31 of the year following the year of the participant's death. And two, while we get this benefit of a delay, really we have to look back to day one when the participant died and say that all income growth, loss, expenses, contributions, anything like that that happen after the participant's death get proportionally allocated to each of these sub-accounts. But the benefit is that if we can achieve this, all that we're going to count in each sub-account is that beneficiary to determine, one, if we have our all or nothing rule where everybody has to be designated or eligible designated beneficiaries, and two, who's going to be the oldest beneficiary dictating the payout period, depending on that classification. So this is easy to achieve with individual beneficiary designations. But when we're dealing with trusts, we don't often end up with this because under the old rules, there was explicit instructions saying that we couldn't use separate account treatment for see-through trusts, which creates a problem because many revocable trusts end up being split into separate sub-trusts at the death of the participant, or they may be split into separate shares that get distributed outright. So it could be all outright shares, it could be all shares in sub-trusts, or it could be a mix of those. So under the old rules, typically what we ended up having to do is look at, okay, we're going to have to now name specific sub-trusts as the beneficiaries. But now the new rules do allow us to create separate accounts for trusts. We'll dig into this a little bit more, where what this could potentially let us do is just name, I've labeled it the master trust, but really it would be our revocable trust in this situation, as the beneficiary, and then we can use the separate account rules, at least under the current rules, to say that if sub-trusts are created, then we can create a separate IRA account for each sub-trust and look solely at the beneficiaries of that sub-trust to determine if we have any bad apples or if we can achieve all DBs or all EDBs, depending on the type of see-through subtrust we have. And again, we're not going to get into the conduit or accumulation trust rules or applicable multi-beneficiary trusts. That kind of gives us our universe of beneficiaries we might take into account. But really, that's more of a determination for after we actually create these separate sub-accounts and subtrusts. So in this situation, we still have the same December 31 deadline, but we're going to run headlong into some other inconvenient issues that we see with revocable trusts that we're going to have to address. Namely, that the trustee can't have discretion as to how the retirement asset gets divided among subtrusts. So, for example, if you had 50% to charity and 50% to a spouse, for example, we couldn't just say, or the trustee couldn't just say all retirement accounts go to the charity to fulfill that 50% share first, even though that might actually be more tax advantaged to the trust itself. So with that being said, under the old rules, before we could achieve this outcome with subtrust, as I briefly mentioned before, we used to have to actually look post-division and say that the subtrusts themselves had to be named as direct IRA beneficiaries, which really created this conundrum of how do we create an effective beneficiary designation. Kind of the minimum effective dose ended up being that we had to name and identify each subtrust, which was hard to do to begin with. There was no art as to how exactly you do that. And then, two, we had to call out explicitly in the beneficiary designation the amount that was going to pass to each subtrust. The safest harbor was to do that by percent or fraction, maybe by dollar amount, although that has its own issues. But more often, what we leaned to was the use of a formula such as per stirpes. The problem was we couldn't rely on the trust language in doing this. We had to often include a definition of that formula or restate it as well, whether it's based on per stirpes or per capita or something else. And if we use that safe harbor of percentages, this didn't address what happens if, for example, a beneficiary predeceases the participant. That could gum up the works in terms of how we actually word that beneficiary designation. And if we had outright shares going from the revocable trust, not into a subtrust, but directly to an individual, we were better off naming that individual directly as an IRA beneficiary because while there were some private letter rulings before that allowed us to maybe pass that through the trust as a temporary entity such that it's like the individual was named as a beneficiary, what I've called a drop down or bypass treatment here, that might not have been possible without a private letter ruling to rely upon. So, in this, what we found out and what we're going to dig into a bit more is that under the new rules, it is possible that if a revocable trust is completely split into subtrusts, we could just name that revocable trust as an IRA beneficiary now and get separate subaccount treatment for each subtrust if one, the trustee has no discretion as to how the retirement asset is divided among the subtrusts, two, that distribution or division occurs immediately or no later than December 31, and we'll get into that time frame a little bit more. And also, three, all post-death activities get allocated to the separate accounts proportionately. At best, this requires language changes for a trust where you still can make those changes. Now, we're not going to get into the language changes in terms of actual words you can use today, but we're going to conceptually know what those language changes need to be. And the bad news is that this isn't good enough. One of the issues that often arises with a revocable trust is that if you have a revocable trust, typically it acts like a substitute for the estate in that creditors of the probate estate itself or the participant's estate maybe are potential beneficiaries. And you might also have charities in the mix as well. All of those are bad apples that spoil the entire bunch and force us into the 5-year rule or the ghost life expectancy rule. So when we look at this, there is one rule that allows us to work around a situation where maybe we can't change the trust and we have those bad apple disqualifying beneficiaries. And that's that we have now a September 30 disregard date where by September 30th of the year following the year of the participant's death, certain beneficiaries can effectively be removed. That's the good news. The bad news is that there's only two ways we can really get there. The first is somehow, if we can have the beneficiary disclaim or get paid out by that date, then we could remove them and we don't have to count them for these purposes. So that could help avoid that bad apple or get that bad apple out of the bunch so it doesn't spoil things for everybody else. Now, this has its own issues. One, the way the rules are worded is that the payout has to be of the entire benefit which the beneficiary is entitled to from the retirement asset itself, which really suggests that the payout has to come from the retirement asset. So if you were to just pay this with other trust assets, that may not work. And there's another option where potentially the beneficiary could disclaim. Now, if it's a creditor, how likely are they to actually disclaim or cooperate with you in that process? Now, it's not often that a creditor has a direct benefit. More often, they're a creditor of the probate estate. So the probate estate could potentially disclaim as well. But it has to be a qualified disclaimer. And while you have 9 months to do that, note that as we looked at earlier, especially if you die after the required beginning date, there's a distribution that has to be made by December 1 of the year of the participant's death. That distribution may come before the 9 months runs on a qualified disclaimer, so we can't necessarily meet it if we wait until after that December 1 payment date, because one of the prerequisites for a qualified disclaimer is that there can't be any benefit received in the interim. And while the benefit is to the revocable trust itself and not the probate estate, that's kind of the danger you run there. And also, a qualified disclaimer has another prerequisite that it can't be for consideration. So, if you were to pay out, let's say the estate or creditors with other trust assets, not including the retirement asset, you also run the risk that that's going to be treated as consideration for that disclaimer. Now, again, these are really hypotheticals, but they're things to think around that may keep us from using this payout rule for disregarded beneficiaries as an effective workaround. So, all of these are things we need to keep in mind where ultimately the better way we would get there would be if we had language in the revocable trust itself that clarifies that creditors or the estate or anybody else can't get paid from retirement assets. Now, that's all fine and dandy if you're working with an existing client who can still amend their revocable trust. If you're administering a revocable trust where client has already died, it may appear that it's too late to do this. But the good news is that even if we can't deal with the disclaimer option or the payout option, we do now have rules that recognize that you can modify or decant a trust. And those explicitly say that you can use a state law modification or decanting statute to remove problematic bad apple beneficiaries by September 30th of the year following the year of the participant's death. But again, we do have that ticking clock. We have the issue that we may have to get court approval. We have the issue that with decanting, you have to notify beneficiaries, which might include creditors. And you also run the risk too there that they can object. And that depending on the state law, there's some states where you can't necessarily remove beneficiaries through the decanting process. So in that case, you might be forced into a modification that has to be approved by the court, unless somehow with the UTC, you can work around that with a non-judicial settlement agreement and get creditors to consent to signing that. So, with that being said, we also have another issue where we don't always have subtrust, as I mentioned. Sometimes the revocable trust really has a temporary existence. It's only there kind of as a pseudo probate estate that's avoiding probate, that really just acts to help us gather assets and then distribute them outright to the beneficiaries who are going to receive them. So, in that situation, I briefly mentioned that drop down or bypass treatment. Can we use this new separate account rule to address that treatment when there's separate outright shares instead of subtrust? And the answer is maybe. There are proposed regulations that would allow us to use the separate account rules for outright subshares. However, that only works for a revocable trust. It does not work for an estate. So, for example, if you had an estate named as the beneficiary of an IRA, you'd pretty much be stuck in that land of having a 5-year or ghost life expectancy payout. Now, there have been situations where a spouse has been able to take a rollover or a spousal IRA where they're the sole beneficiary of the estate, but that's not under the minimum distribution rule framework we're doing here. It's more in the separate IRA rollover rules that you have that recognized. So that's something outside of the scope of this that we can't necessarily do for an estate. Now, while we have these proposed regulations, it may be possible that it goes through a comment period that's already closed and somebody's brought up that estates should be addressed, but in the rule as it exists today, we don't have that treatment. We still have to just use a revocable trust itself, which kind of leads us to this situation where what we're going to find out is the rules have a fundamental flaw in that they're not clear on whether this has to apply in a mixed situation where you have a mix of subtrusts and outright shares, or whether it could apply where all the shares are outright. But most likely, to say that you have to have a mix is going to be a very twisted reading of the proposed regulation, in my opinion, and it could allow us to get here. But here's a quick view of the regulation. You don't have to read it, but really it acts as a carve out for the separate sub account for trust rules to say that if a separate interest is not going to go into a subtrust, but is going to instead be held directly by the beneficiary, then that won't cause a trust to fail eligibility for the separate account rules or eligibility as a see-through trust. But that kind of brings us to a bigger point is that in order for any trust, like a revocable trust that's named as a beneficiary, to have its separate subtrusts qualify or its separate sub shares qualify for separate account treatment, the trust itself has to be a see-through trust first and foremost. That's another rule, another issue we'll get to in a minute. But we see that we have one example in the explanations that's kind of carved out here where really what this describes is a situation where three children have equal interests where if one trust is going to go to, or one share is going to go directly to a child and the other to subtrusts, or vice versa, that's really the example given as to where this proposed rule would apply. So you can see how this would get confusing because the example doesn't call out that it's all outright distributions. It calls out a mix of a subtrust and then outright separate interests. So whether that is a twisted reading that designates this isn't part of the reg. And like I said, I think that would be a stretch to claim that you'd have to have a mix in order to qualify. I think we could still get there with all outright distributions, assuming we can avoid those bad apple types of distributions to begin with. So, like I said, this seems like great news out of the gate, but as with anything, we run headlong into some other inconvenient issues. One is that the revocable trust itself must be a see-through trust. Most likely, it would have to be an accumulation trust within our three types of see-through trusts that are indeed permitted. And necessary to that, too, would be that knockout of bad apple beneficiaries by September 30th. If we don't already knock them out by custom drafting in the trust itself. Excuse me. We also have another inconvenient truth that the way the regulation is worded is that it says that the trust, in order to qualify, must also be immediately divided into the separate shares for which sub-accounts are going to be created. Now, the regulations do say that there's a reasonable administrative delay permitted, because as we all know, trusts are never immediately divided. It takes time to collect assets, figure out what's in there, and then divide it up. So you're looking at least a 1 or 2 month process at best, and sometimes I've seen it run 3+ years while we wait out the estate tax limitations period. So it's rare that we're going to have immediate division, and unfortunately, this is undefined. We don't know if you're going to somehow fail this if you last beyond some sort of finite number of months that somehow keeps us in the eyes of the IRS from having an immediate division. At best, what we have is a hard deadline that I mentioned earlier of December 31 of the year after the year of the participant's death, which is our deadline for creating sub-accounts. Now, if you have somebody who dies earlier in the year, that gives us a longer window, closer to 2 years to do this. If you have somebody who dies later in the year, it gives us a shorter window. It's kind of the unfortunate wording of the regulation itself when we see these different December 31 or September 30, whatever types of deadlines for the year after the year of the participant's death. But with this, we're going to need some custom drafting if we still have time and if we want to pursue this outcome. So, with that being said, this kind of brings us to our closeout set of points here for this presentation today. And then I will open us up for questions. And really, the key takeaway is that our new rules, both final and proposed, might give us the chance to directly name a revocable trust as IRA beneficiary while preserving stretch treatment for each individual beneficiary of the trust itself as an outright recipient or as a through a subtrust. But to get there, we're going to have to create separate accounts under the new separate account rules and proposed separate account rules for each subtrust and for each individual outright distribution. So to get there, we're better off clarifying this option in the language of the trust itself instead of just naming the trust as beneficiary and seeing how things are going to shake out. So our minimum effective dose when we're looking at language changes is going to be one, we need to clarify that the trustee has no discretion to allocate retirement assets among the separate accounts or subtrusts. It has to flow naturally to those based on the formulas in the trust itself. Now, if we're doing this, there's one thing I want to call out that I don't have in the slides itself, where I've seen varying opinions from thought leaders on this, that usually when we divide things up, like in the residuary, we're going to have percent allocations, whether it's under a per stirpes or per capita rule or some other division among members of a class proportionately. On occasion, though, we might call for a pecuniary payout. What's a pecuniary payout? That's where we have a specific dollar amount going to a beneficiary. Now, there's been suggested that if we have that and we allocate out a pecuniary amount to a beneficiary under these rules, that retirement assets are called income in respect of a decedent. And when income in respect of a decedent is used to satisfy a pecuniary amount, that is treated under tax law as if, in this case, the trust received that cash directly and then distributed it out. So in other words, we lose the ability to defer tax and stretch distributions there if we carve out a pecuniary amount as a subaccount from a retirement asset. That potentially that would then be treated as if that was satisfied in cash, and that cash was generated by the trust itself taking a taxable IRA distribution to satisfy it. We also have, in addition to that requirement, in our minimum effective dose, is adding language that clarifies that any entity, whether it's a creditor, the participant's estate, somebody else, cannot be paid from retirement assets. Now, if you have charities in the mix, that gets into a little more complicated territory where potentially, yeah, we could do this, but what we're going to want to have potentially is language clarifying that the charity itself could be paid from the income of the trust, which might allow the trust to withdraw some funds from the IRA, pay them out by September 30th of the year after the year of the participant's death, and in change get a charitable income tax deduction at the trust level under Code Section 642C that then offsets the tax from taking that distribution from the IRA. That's actually a much more tax efficient way of doing that, but again, we get into some custom drafting needed to get there. Now, we have definite rules when it comes to separate subaccounts for trusts or subtrusts. We don't have final rules when it comes to subaccounts for individual beneficiaries of a trust who are receiving their distribution outright in the form of a direct IRA for their benefit. So I don't see a world where the IRS would deny that type of treatment. I think you could still rely on that proposed rule for now, but I think it's important to call out that there probably will be some changes to that rule before it becomes final. If it indeed does become final, because keep in mind, the old Secure Act regulations that were just finalized in July were out there pending for almost over 3 years before they became final. Now, when we have bad apple beneficiaries, if we haven't been able to effectively eliminate them by our minimum effective dose of custom drafting in the last slide, then we have to look at the possibility that we either have to pay them out by September 30th of the year after the year of the participant's death, or even have them disclaim, or we have to modify or decant. Both of those are problematic options, as I mentioned. The payout has to come from the retirement asset itself, and it's hard to determine exactly what that amount might be. Whereas if we pay it from other assets, that wouldn't necessarily be an effective disregard outcome the way that the rules are worded. Disclaimer may not work as well because, one, it may be too late when we have that December 1 payment date in the year of the participant's death if they've reached their required beginning date. May also not work if we're paying out from alternate trust assets, non-retirement assets, because in that situation, we might be deemed to have a disclaimer in exchange for consideration, which is not qualified in terms of the term qualified disclaimer, and also is not qualified the way the rules are worded, which leaves us potentially with modification or decanting. And decanting may not work, as I mentioned, because sometimes state decanting laws don't allow you to eliminate beneficiaries, kind of leaving us with a court modification or potentially a non-judicial settlement agreement. The problem with a non-judicial settlement agreement being that how likely are you to get creditors to actually sign that? That might put you into a situation where you have to get a court order and the clock is ticking. You have to do this by September 30th of the year after the year of the participant's death. Then, assuming we meet all those other hoops, we run headlong into that inconvenient having to divide immediately rule that says at the latest, we have to create separate accounts under the new separate account rules by December 31 of the year following the year of the participant's death. And the immediate requirement may push us up sooner than that. It's still largely undefined. And maybe the proposed regulations will deal with that, but that wasn't part of what was in them, though, that would require its own APA rulemaking process potentially to change that because that immediate requirement is part of the existing finalized regulations. So that's largely undefined, but what I think is that really, if you're going to do this, the sooner you can do it, the better off you're going to be, where really you'd have to carve out retirement asset portions of the revocable trust and get this done, and then worry about everything else and get that paid out. And that may not be practical when we have, for example, a taxable estate with federal or state death tax or inheritance tax liability that's looming over it. So that's kind of the broad picture of what we've looked at. And I will circulate these slides and this recording after the fact. But that brings us to the end of today's presentation. So with that, I will unmute everybody. And if you want, you can ask questions. So let me unmute anybody who wants to ask.
Hey, Griffin, this is John.
Yeah.
Could you flesh out, I've heard 3 times the December 1st date, first up when it came in the context of a disclaimer.
Yeah. Mm-hmm.
I'm certainly aware with September 30th and December 31st. What is the December 1st date?
I apologize. I misspoke on that. That's still December 31, but
Okay.
that rule deals with the year of the participant's death.
Right.
Only if they die after their required
RBD. Yeah.
Yep.
Okay. And then could you also then flesh out the IRD and the charity? Because I'm oftentimes people will name a charity
Yep.
as a beneficiary. Is the tax benefit equivalent or different if you say my beneficiary designation 50% to charity X and 50% to John Doe versus taking it, you have your charitable contribution and you're saying because of the IRD, you get the deduction. I've fleshed that out a little
Mhm.
bit.
Yeah. Well, in that scenario, there's a difference between saying 50% to charity versus, let's say, saying 200,000 to charity. The IRD is almost a separate issue in that,
Yeah, I meant
yeah,
pecuniary. I'm sorry. Yeah.
yeah.
Okay.
So in that situation, either way, I think one of the benefits that is often not included is sometimes it's easy or better with charities to intentionally fail these rules, to have a situation where the trust or even the estate can be the beneficiary of a retirement asset and have the authority given to the executor or trustee to pay the charity from the income of the trust, which would include any IRA distributions to the estate or trust. That would be taxable initially, but there's a 100% charitable deduction for income applied for the benefit of a charity from the trust or estate. So it ends up being a tax wash in that situation. And it becomes a lot more efficient when you can force IRD to pay charities and leave non retirement assets for everybody else. But in that scenario, again, you run into that trustee discretion issue. So that's where you might have to have some custom drafting to say, okay, we're going to primarily pay charities first out of retirement assets and then go for the balance getting split into our separate accounts.
Ah, okay. Thank you.
Yep.
And then lastly, just one sort of practical question.
Mm-hmm.
Let's just say you're not a high net worth family, no dysfunctional family members.
Mm-hmm.
Uh, the pros and cons of naming a trust versus naming individuals,
Yep.
spouses primary, 4 children as contingent,
Mm-hmm.
just for practicality and simplification.
Yep. Well, it all really for me goes back to state creditor protection law. Most states say that IRA assets are protected from creditor claims. So the compelling reason to use a trust is to help avoid creditor claims. And it used to be that since the IRA was an adequate substitute, we might not have cared as much about naming an individual as a direct beneficiary. About 10 years ago, maybe 11 now, there was a federal bankruptcy case, Clark v. Ramaker, that said we're only going to extend that protection for IRAs, that unlimited creditor protection, to somebody who's actually funding it and contributing it. If it's an inherited IRA, that case said there's no federal bankruptcy protection because potentially the beneficiary could just raid that entire IRA for their benefit. There's no strings attached. So what's the compelling reason to protect that from creditors? Because arguably a beneficiary has no retirement savings needs as opposed to somebody who's contributing. So that was really what kicked off a lot of the conundrums around it might be better to have IRAs then going into a trust because you're putting in another layer, preventing that rule from kicking in, that eroding protection from for inherited IRAs to then say, okay, if we put a trust in place, that's a workaround. But again, we run headlong then into are we getting stretch treatment or are we stuck with a 5-year rule in that situation? So that's really the general reason. The other being that let's say you have somebody who has special needs or might need government benefits in the future that are means tested. Because of the minimum distribution rules, if they're a direct IRA beneficiary, you're pretty much immediately going to kill their eligibility unless they disclaim, which may not be an optimal outcome for them anyway. So when we see this intersect with special needs planning or supplemental needs trust, that's really another situation where this type of planning is helpful.
Definitely get that. And thank you for answering all three. Those were very helpful. I
Yeah,
appreciate it.
absolutely. All right. Anybody else? I apologize. I went through everybody's muted and I tried to unmute you all, but I think it requires input on your end as well to do
All
so.
right, one other comment. I just saw that you did a on Limeberg elephant IRAs. Are you going to do anything similar or equivalent on your platform?
Yeah, potentially. Because I worked on it with Paul Hood.
Hmm.
There's permissions I have to get
Understand.
to
Hmm.
share some of those. So yeah, really what I'm doing is taking one bite of the elephant at a time and dripping things like today's article, like on basis of assets from a Roth IRA.
Hmm.
So that's kind of my practical workaround
I appreciate that.
to
Thank you.
ask forgiveness instead of permission.
Great presentation. I'm
Yeah,
gonna cut out. I have to get something, but I want to thank you very much. It was great.
absolutely. Thank you, John.
Bye.
And I'll stick around for anybody else who has questions.
Hey Griffin, Seth Connell here.
Hey, Seth.
So, question that I'm trying to, I guess, wrestle with a little in my mind. I think I know the answer, but I just want to see your take on it.
Okay.
So, a couple of clients have wanted to have their minor child as the main beneficiary of their revocable trust, but they also want to have a specific bequest of a dollar amount go to somebody who wouldn't be an eligible designated beneficiary. My thought is to have a clause in there stating that that specific bequest is prohibited from being funded by retirement benefits, and that it has to come from another part of the revocable trust assets. Do you think that's sufficient to keep that account treatment for the eligible designated beneficiary?
Yeah, absolutely. And in that scenario, I think you could still get separate account treatment and still protect EDB treatment for the minor child, but in the process, that other non-EDB who's getting a pecuniary payout, they're going to get taxed in full for that full distribution. They're not going to be able to stretch in their IRA. It would benefit them more to get the cash than it would to get a separate IRA account.
Yeah, because I guess what I'm saying is that the pecuniary amount, like 25,000 was one number a client wanted to do.
Hmm.
They wanted that to be a distribution from the principal of the trust, whether it was bank accounts or a brokerage account from sale of the house, but specifically stating that that bequest could not be satisfied by retirement benefits, just to make it abundantly clear, they're
Yep.
not to be considered a beneficiary for retirement account purposes.
Yeah. Yeah, I think that's a good addition to clarify that. Now, depending on the size of the dollar amount, you if it's 200,000, 300,000, you could easily run into the situation where there's not enough from non-retirement assets to indeed fund that. So that would be my only caution. But yeah, that pecuniary amount accelerating IRD, that's not unique to this because in any situation, if you were to pay that out with non-cash assets, that's where you run into what's called the Keenan gain, where either way, you'd either have acceleration of retirement assets or IRD, or if it's in kind appreciated property, you'd be treated as if the trust or estate sold it and distributed the cash, which might not be so bad for a stepped up basis piece of property, but you have to determine it based on fair market value on the date of distribution and not necessarily date of death.
Right. Yeah, it would be a cash gift is what my client wanted to
Hmm.
do because I've
Okay.
got I think it was from Lexus. It was a retirement benefits clause. If they have one for conduit and one for accumulation, I've kind of tinkered with the language a little bit,
Hmm.
but specifically stating that only the named beneficiaries in Schedule B can receive anything from retirement accounts, just to try to make it abundantly clear anything else that may be given to somebody else, they're not getting anything from a retirement account.
Yep. Yeah, I think that's great. Yeah.
Okay, great.
All right. Anybody else? Going once, going twice. Well, if you have any questions after the fact, feel free to reach out by email if there's anything you wanted to ask and didn't get answered. But I thank you all for joining me today. Like I said, I'm trying to do these types of things monthly based on some type of topic. So stay tuned for subsequent months and what that topic is going to be. And always feel free to join into this or office hours. I haven't been able to do any office hours this month because of busyness, but I should get some of those slots back open end of month and into June. So watch for opportunities like this. And if you see them, I encourage you to join. So once again, appreciate everybody joining. I'll circulate this in the slides after the fact. And if you have questions, please reach out. But thanks again. I hope you enjoyed this episode. If you would like to take your education to the next level with exclusive article series, webinars, one-on-one office hours, and more, please consider a paid subscription to State of Estates. For $30 a month or $300 per year, you can receive education that is higher quality and higher convenience than is provided by most bar associations, CLE providers, and professional programs. To subscribe, please visit griffinbridgers.substack.com. And if you'd like to supplement this content, you can also watch or listen to my YouTube channel. Just search @GriffinBridgers. Thank you again for listening.